Hello and welcome to another edition of Insurance Answers. I'm Billy Bray, and today we're going to be talking about international insurance. So I've got this question from a lot of companies, and I see them do this wrong. And there's just a better way. There's a better way to expand into a new market and buy your insurance. So I started to type out this long email to my friend Luis Chavez that's working with a client specifically, and I decided just to bring this to you in podcast form in a video. I think there's a lot of folks that could benefit from this. So here's the scenario, and I see this a lot of times. If there's a company domiciled in a certain country and they're expanding into new markets, new countries, they'll set up a separate profit center and let that new entity or that new country basically run its own business. And then oftentimes there's financial backing from the parent company, and sometimes there's a franchise type of fee or profits that go back to the parent. That's all fine. Customize that. Do what works for you in your business at your company. But when it comes to the insurance, there's a better way. So when you set up a separate profit center, a lot of times you'll say, okay, you're responsible for all of your expenses, for all of your vendors, for all of your insurances, this, that, and the other. Okay, that's fine. But in order to be more profitable as a parent company and to be more profitable as that new location, let's just use an example of a company that's domiciled in the United States. They want to expand into Canada, all right? So they say, okay, Canadian operations folks, go build your business. And, the money flows this way or that way between the two of us. But essentially, you're on your own, right? But you've got these standards, you've got this franchise type model set up. The issue with that when it comes to buying your insurance, and I'm talking property and casualty insurance, all right? Here's the problem. You don't get economies of scale. You're a new business, so you're rated as a brand new business, basically with no experience in underwriting. So those two things hurt you. But when you look at the economics and the efficiency factor, it really doesn't make sense. So here's what we're going to do. I'm going to take it from the perspective of the parent company and the perspective of the company that's being set up abroad. For the parent company, here's how you win, all right? You set up an international insurance program that you buy all of the insurances, you have control over all of the insurances, and you know for a fact that the insurance in place is going to protect not only you as the parent, but the company that you're expanding with outside of your geographic region. Without that control, you may lose money in a claim scenario. And that's bad for everybody involved. All right, so here's what we look at in terms of that. If you make your new company that's in Canada buy their own insurance, you're going to require them to send you a certificate of insurance as proof of insurance back, right? That's fine on the surface level. When we get a little bit deeper, there's a huge problem there. You don't know what the exclusions say. You don't know what the endorsements say. You don't know the quality of the insurance carrier or broker. Those things can all lead to problems. Yeah, I mean, the majority of the time, you'll probably be fine. But it's not the majority of the time that we're worried about. It's that one time that you have an unpaid claim that messes up your new Canadian operations and they can no longer send money back to the parent company. All right? The way that you win is you set up an international insurance program. An international insurance program that you have control of the broker, you have control of the selection of the carriers, you know what the coverages are, what the endorsements are, what the exclusions are, what the actual coverages are, and you can also negotiate the premiums. Here's the way that you really win. Okay, so when you're working with your broker and you're working with the carrier, what you're gonna do is you're gonna say, listen, I've got my US operations, we've got Canada opening up, and here's my 3 to 5 year business plan. We've got Europe opening, these different markets. We've got Central and South America opening, these different markets as well. Use that to your advantage to get economies of scale on a going forward basis as you're just starting to expand internationally. Now, if you're a business that happens to have operations internationally already, what you're gonna wanna do is take the entire portfolio, take that to the marketplace, get insurance for that portfolio, and now you've got the insurance, and then you can bill back each entity its allocated amount. You can bill them back with a 2% service charge on there if you want to, and probably get by with it. And they'll be happy because it takes time off of their plate, and you'll be happy because you get a little bit of a 2% service charge fee because you just helped them do part of their job. That works well for the parent company. Now, for the company that's expanding internationally, let's say we've got the US-based parent company, and now we're going to put ourselves in the shoes of the Canadian-based operations that's brand new. If you go try to get insurance, you're going to be rated negatively because you're a new business. If you don't have 2 or 3 years experience in that business, in that country, with those specific operations, that can work against you. Now, there's a case to be made that, yeah, well, I worked in the US operations, we're just expanding. Some underwriters will get that, some won't. Sometimes you can use the parent as a mentor or build off of their resume, so to speak, to be able to negotiate with an underwriter on that. I'm not completely convinced that every broker negotiates in terms of that. So now we're trying to get insurance, we're a new business. Well, you don't know what necessarily you need to buy, or maybe you say, hey, the parent company says I need these types of insurances. And then how do you select your broker? Well, that's a question that you've got to ask yourself rhetorically. How do I find the right broker? How do I find the right carriers? How do I know I'm buying the right insurance? How do I know I'm paying the right premiums? How do I know when I have a claim I'm going to get money back? Well, maybe you don't. But your parent company, and we'll just assume that the parent company is sophisticated, right? If they're expanding internationally, one would think that that's the case. When the parent company can come in, build you a program, give it to you, you plug and play, you pay some premiums, maybe you pay the 2% service charge, maybe you don't. Maybe they don't require that. Then even better. That's a real win for the company and the operations team that's expanding to that new market. So rather than being out all by yourself trying to figure out how to place insurance, well, even if you've done it before, it can be tricky because you're a US citizen, now you're in Canada. The laws are different, the taxes are different, the healthcare system is different. There's a lot of problems when it comes to workers' comp and health insurance in Canada because it's completely different than what we've got here in the US. So instead of worrying about all of that, those things that can be distractions, you want to get up and running and start getting your new customers, getting purchase orders, and expanding your business, interviewing, hiring, and training your new staff as well. So there's a better mousetrap. What I see a lot of times is the parent company will say, hey, go buy your own insurance, and now you've got to go buy your own insurance. Well, it's your responsibility as that country's representative to do that. Okay, that's fine, but if we shift our mentality to the parent company takes care of everything, and then you add these other locations as they come on, bill that back. So the parent company would bill that, basically their allocated amount, to the Canadian operations in this case. All right, so the parent company does not lose. The parent company wins because they gain control and all of these things that we've already talked about. Now, if you've got operations in several countries right now and you're having each country buy their own insurance, well, let's think about this. Each of those countries are buying their own insurance so they don't get economies of scale, okay? There might be a one-off, something interesting where they would, but in most cases, this is not going to happen. So if the independent countries are not getting economies of scale, they're not getting the best pricing. They're not making the most profit that they could because they're inefficiently buying their insurance. So they lose. The parent company could sustain more revenue or more growth without wasting those premium dollars. So what I encourage you to look at and consider and think and talk to your broker about is, how do you form an international program that's efficient, that you can have full control over, and that's high quality? You can bill back your separate entities or your separate companies the allocated premiums, and a good broker will be able to help you with that. It's not that complicated. Then you can really win. But if you're having each of your new entities or existing entities purchase their own insurance, it can lead to problems that are just easily avoidable by doing what we just stated. Again, I'm Billy Bray. I'm your host of Insurance Answers and the proud author of the book on buying insurance. So look forward to more videos, and I hope the content today was valuable.